Hello and welcome. You're watching the Global Reset with me, Prashant Nair, here on CNBC-TV18 Prime. This is the program where we connect the dots between global trends, markets, and economies. We explore the implications for businesses, investors, and individuals. That is you. We will be today speaking with a special guest. Robert Sockin, global economist at Citi, will be joining us in short order. Robert began his career focusing on global trade research and has had several years of experience analyzing economic data. He contributes to macroeconomic research and in-depth policy analysis. And that's a conversation you don't want to miss, especially in the light of what's happening with regards to trade. Before we get to Robert, let me quickly get you up to speed with what happened overnight. It was a lighter day, lighter than normal day. The key word, of course, is trade deals. As the August 1st deadline draws closer, trade talks continue between the US and other countries, including India. Now, sources tell CNBC TV18, these are government sources, that an India-US trade deal is unlikely before the 1st of August. The deal was stalled with the US, that is the United States, wanting to impose a 20% tariff on India, but at the same time expecting zero tariffs in return. Sources add that the Indian government has declined to hold any further talks this month and that a negotiation team from the United States would be visiting India in the month of August, with a deal breakthrough likely to happen only in September or October now. Now, on similar lines, U.S. Treasury Secretary Scott Bessent spoke with CNBC in an interview and said that it was the quality of deals that mattered, not the quantity and not the timeline. Listen in.
Talks are moving along, but the important thing here is the quality of the deal, not the timing of the deals. And President Trump has created maximum leverage, as only he can do. And what we are seeing is like these imbalances built up over 20, 30, 40 years. And we are more concerned with high quality deals than getting these deals done by August 1st. Our trading partners were told that the rates could boomerang back toward the April 2nd levels. We can continue talking then, but again, we're proceeding at pace with the negotiations, but we're not going to rush for the sake of doing deals.
All right, we're not going to rush, and President Trump has put in maximum leverage as only he can do. Those are Scott Bessent's words. This is an ongoing story. That's the context, essentially, right? Let's get in Robert Sockin, as promised, global economist at Citi. Robert, great to have you with us here. Appreciate it. As we go into this 1st of August deadline, markets are assuming that at least a couple of countries will get a tariff. I think till we put the story out, primarily India was on that list, South Korea was on that list as well. How do you think about this? The expectations going into the deadline, which is just about 6 or 7 days out.
Yeah, thank you very much. And this is a great question. And, if we look at the last few weeks, the administration has really ramped up the intensity on these trade talks as we're approaching the summer, and they've extended kind of the deadline or announced the deadline of August 1st, and we're watching very closely to see what happens as we head into that deadline. I think we're taking the administration stance very seriously. And we think that as we go into that deadline, we could see much higher tariffs than we were expecting just a few months ago. I think as we get into there, I'm hopeful that we'll see some trade deals coming through over the next few weeks. We have not seen many trade deals come through so far this year, but the administration has been negotiating with many countries around the world. Those negotiations have been going on for months in some cases, and but negotiating trade deals is very challenging. So it's possible we'll see some more deals, or at least frameworks of deals. But it's also possible that that countries need more time to negotiate, and we won't see a lot of clarity going into that deadline. I do think that it's likely that the administration is serious on its stance that tariffs will be much higher than maybe we most thought a few weeks ago. But it's still unclear if that August 1st deadline will be binding for all countries. It might be that for some countries where negotiations have been going very well or relatively well, that you could see a further extension to allow time for negotiations. But it could be that for other countries where progress has been slow, that the administration really wants to ramp up the pressure, and you could see those much higher tariff rates that have been threatened come on board during that time. So a lot of uncertainty as we head into later in the summer. But I do think that the risk that tariffs are going to be much higher than we've been anticipating over the last few months has risen significantly. And that August 1st deadline is very important to watch because it seems unlikely that we'll get a blanket extension for all countries. I don't want to rule one out entirely, but I do think we are seeing a much more intense stance on tariffs than we've seen for the last few months.
Robert, so, and that's very well explained. So end state tariffs, I mean, final tariffs could be north of 20%. I mean, 20 plus. That is much higher than what expectations were a few months ago.
I think that is the risk that we're living with that looks increasingly likely. If you look at our outlooks that we've been writing over the last few months, we've been thinking that the effective tariff rate in the U.S. could end up somewhere close to 15% or maybe a bit above, maybe somewhere between 15 and 20. That's kind of what our assumption has been for once all tariffs are announced and deals are settled. Those are the type of numbers that have gone into our forecasts. But now it's looking like we could end up north of 20%, maybe near 25% is possible, and could even be a bit higher than that, depending on how things evolve and what type of tariff rates are assigned to certain sectors, products, and countries. So I think I'm hopeful that we don't end up with rates that high, but it does look like it's drifting in that direction. And it's important to note that before President Trump took office, the effective tariff rate on US imports was around 2.5%. So at 15 to 20, it was already a very large increase from where we were. But 25 or thereabouts would be significantly higher. And we're talking about the highest tariff rates at those levels since the early 1900s.
Yeah, I mean, 25% would be quite something, Robert. What probability would you put to this 25% number? Would it be high? 50% plus probability that we'll end up with 25%? Lower?
I don't think it's necessarily over 50%. I think it's more likely that we end up still, as deals are settling, somewhere closer to 20, especially because, as we saw with the deal that the administration struck with the UK, it's possible that countries are going to have carve outs for certain products and sectors. We saw that with the UK auto sector. And so there is some potential within these country deals for relief for key products. And so I still think it's likely that we end up maybe more likely somewhere closer to a 20% effective tariff rate. As I said, I'm hopeful it could even be below that. But the probability has certainly risen that we end up nearer to 25. So it's not higher than 50%, but maybe it's somewhere closer to 25% or thereabouts. And again, would be a substantial headwind. I think if we end up with rates that high, it would require further downgrades to our global growth forecasts. And I think it'd be very challenging for companies. I think tariffs at those levels would be very hard to absorb into margins. I don't think there's enough margin space to be able to absorb that type of shock. And we're going to see a lot more pass through onto US consumers, higher US prices, and that's going to put additional strain on the US economy. So it could be a very challenging environment.
And Robert, I mean, challenging environment, because it's kind of unexpected, right? Markets are still working with final tariffs of between 10 to 15%, or you think the consensus has moved from there?
I think it's been a bit of a puzzle when we look at how tariff news is evolving and then how financial markets are processing that news. It doesn't seem that as we're getting a lot of these tariff threats and announcements, that markets are responding very much. So it's a bit puzzling to try and figure out what they're exactly pricing in. It might be that markets are looking at the first half of this year, where the US and global economy have largely held up quite well. Tariffs have not been as disruptive as we would have thought. And they might be pricing that they're not going to be as disruptive as economists are thinking. And companies are able to adapt to these tariff rates. And so that might be what we're seeing in markets. And underneath that, I would imagine it's a tariff rate that's below 20%, closer to 15 or maybe 10 being priced in, certainly somewhere below 20. So I think if we were to end up in that 20+% range, you could see some challenges in markets as well, because I think everyone or most would agree that tariffs at those levels would create additional challenges above, let's say, a 10 or 15% tariff rate. And when I speak with many clients around the world, that is the sentiment that I hear as well.
By the way, Robert, is August 1 the final deadline, you think, or is another push out likely?
Yeah, it's a great question, and I think it depends on a few factors. I think it depends on how well the markets and the economy hold up during the next several weeks. I do think the administration is very responsive to those conditions, and so if you were to see a very large market sell-off, for example, or a sharp rise in layoffs in the economy, I think that could lead the administration to kind of roll out these deadlines or maybe soften that deadline somewhat. So it does depend on economic and market conditions. And as I mentioned, I think it could depend also on countries. You could see higher tariff rates come on for certain countries where maybe negotiations are not going as well, and the administration wants to accelerate those negotiations. But ones that are going well, you could see an extension. So I think that's a possibility as well, that you could see it vary by country. But I think what we're seeing from the administration, and we're taking it seriously, is that you're not going to see a 90-day extension as we saw earlier. That they're really seem to be emboldened by the strength in the economy and strength in markets in recent weeks, and they're trying to push that agenda forward. So if you get some type of extension, I don't think it'd be a broad-based one, and I don't think it'd be a very long one like we saw in April.
Absolutely. Now, Robert, financial markets are what they are, but the US economy, right, is looking through the tariffs. Kind of Teflon coated, would you agree? Data points, look at jobless claim numbers, which are low, consumer confidence remain pretty solid.
Is great question. We are grappling with this as well. And admittedly, the US economy, which we have been saying would be the hardest hit by the tariffs, has held up remarkably well. The global economy has held up well as also, but the US in particular, we've been very impressed with the resilience that we've seen. You see noisy spending, but in general, retail sales continue to move higher. The labor market continues to be fairly tight. You're seeing a bit of strain in certain areas, like continuing jobless claims are higher than they were at the beginning of the year, but they're not high by historical standards and kind of moving sideways at recent levels. And if you look at the price side, you're starting to see a bit more evidence in the latest hard inflation data that tariffs are pushing up prices for certain products, but it's certainly not broad based. And inflation overall has not really accelerated yet off of the tariffs. I think what is happening though is twofold. One, earlier this year, we've seen businesses and consumers front load a lot of purchases to get ahead of tariffs. That supported activity earlier in the year. Maybe you're seeing that in certain industries and pockets of the economy still. We think most of that's played through, but it could be certain parts of the economy that's still ongoing. And then on the price side, which is really where the disruptions from the tariffs come from, the idea would be that tariffs push up US prices, weigh on consumer real income and spending. We think that's been slower because all of those front loaded purchases earlier this year built up inventories for companies. They're running through those inventories. As they run through that, though, we do expect that they're going to have to pass on more to consumer prices, and that's going to weigh on consumer spending later this year. And when we look at surveys as well, things like the Fed's Beige Book, it does suggest that you're going to see more inflationary pressures as we go later in the year. So we do think the tariff effects are just a bit delayed, and they'll come through in the second half. But that being said, we're not fully discounting the possibility that we're overestimating the disruption effects of the tariffs. It may be that the cost of the tariffs are being shared more between exporters, importing companies. Less will go to the consumer, and they'll be less disruptive than thought. That's a possibility. We haven't put that into our base case. We still have a notable slowdown in the second half. But admittedly, things have been a lot more resilient up to this point than we would have thought just a few months ago.
Robert, we'll slip into a quick commercial break here, but don't go anywhere. We continue our conversation with Robert Sockin of Citi on the other side. Lots more to talk. Welcome back. You're with us here on the Global Reset on CNBC-TV18 Prime. We're in conversation with Robert Sockin, global economist at Citi. Robert, thanks very much for waiting. We did discuss tariffs, what markets are making of it, and the road ahead. Let's now talk about another sort of almost a self-inflicted question, right? This is about the Fed independence. And I've sort of asked my guests on the program over the last many days how they're thinking about this. Now, President Trump's attacks continue sporadically. Simple question, but difficult to answer, I reckon, Robert. Is Fed Chair Powell's job safe?
Yeah, great question as well. I mean, this has been another one of these key topics that's coming up quite frequently in our conversations and in the media. And I think the administration is putting a lot of pressure on Powell and the Fed, given that it has been unhappy with its decision to hold rates this year. We've seen this pressure ramp up at times. And I do think that that pressure is going to continue throughout Chair Powell's term. And so we are going to see continued critical rhetoric from the administration toward the Fed. But at the end of the day, I do not think that Powell will be removed or that he'll resign from the position. I think he will fill out his term, which ends next May, and continue to be committed to keeping monetary policy independent and going by what they see in the data. And to me, given everything that we've discussed about the resilient U.S. economy, they're in wait and see mode. And I think that's what we're going to continue to see throughout the summer. I do ultimately expect the Fed to cut rates, not because of the administration's pressure, but because the economy, as I noted, we think will slow as we get later into the year, and we think inflation will rise. But the Fed will focus more on the growth side of its mandate, and it'll be very hard for the Fed to not cut rates as the labor market is loosening and the economy is slowing. So ultimately, I think the Fed will stay independent. I think we'll continue to hear these pressure on the Fed, but the Fed will stay the course, and we'll see a gradual rate cuts, probably starting in September. That's my base case, but it could be more delayed if the economy continues to stay resilient.
That's well put, Robert. Let's just talk about the unlikely possibility, right? I mean, it is what you don't expect. What hurts you, harms you, has the potential to, as you say, highly unlikely. But if that unlikely outcome were to materialize, and Fed Chair Powell is asked to go, how do you think markets would react in this scenario?
Yeah, absolutely. And this is why, at the end of the day, I think the Fed is likely to stay independent. There's a range of reasons. I mean, but even though the administration would put a lot of pressure on the Fed, hoping that it would start cutting rates, I think if the markets were to sense that the Fed was losing its independence, you would see a very poor reaction. You would see probably equities sell off. You would see long term treasury yields move up significantly because markets would be concerned that the Fed would be politicized and no longer committed to controlling inflation. So inflation expectations would likely rise. That would get priced into much higher long term treasury yields. We saw a bit of this in April or earlier this year, where the administration was floating the idea, or at least it was floated in the news, of potentially removing Chair Powell, and markets reacted very poorly. And the administration seemed to back down on its stance, because at the end of the day, I think that the markets value the Fed's independence. And so, to me, the markets are kind of a corrective mechanism or a forcing mechanism that emphasizes Fed independence. And so that's another reason I don't think it's going to come to that at the end of the day, because I think if we were to see that, the market reaction would be very volatile and very poor. And that can be, as I said, sort of corrective mechanism. So I think the Fed's going to stay independent here, but we're going to hear a lot of noise and a lot of pressure to ease policy in coming months.
Robert, let's come to India, right? What is your view on the market here, the economy here? Your global equities team downgraded India in their overall sort of rankings and weightage. But that could be a function of valuations and near-term earnings growth lagging, etc. But India's macros remain absolutely solid. Where does India stand for you in your own reckoning? What you like, what you don't like about the economy, and some of the structural factors here?
Yeah, great question. And we have highlighted many times on this program how India has been, if you look over the last few years, one of the most resilient and impressive economies around the world. If you look at our global forecast over the last few years and which economies outperform those forecasts, India is at the very top of the list. And going forward, we have a very constructive forecast for India as well. We expect the economy to grow somewhere around, let's say, 6.7, 6.75 range for the foreseeable future in terms of real GDP growth. So this is a very robust growth story. And when we look at India, there's a lot of positive factors that we've highlighted many times. Very supportive demographic profile, government policies that are trying to support key areas of the economy. And I think very much the economy is positioning itself well to be a leader in a lot of spaces where we see a lot of growth in the world going forward, things like high tech manufacturing, technological services. And so I think that that is going to continue to be an important area of growth and tailwind, not just for India, but for the global economy as well. So I continue to see India as an extremely positive growth story, and one that's going to continue going forward. And I'm hopeful as well, linking this back to what we were discussing on the US. I'm hopeful that India is one of the economies that we will see a deal relatively soon compared to others with the U.S. administration. India's been negotiating with the U.S. With the Trump administration for some time, one of the sort of earliest countries to be negotiating, and I'm hopeful that we'll end up with at least a fairly positive or relatively positive deal on that front. Position India well, given this sort of new challenges to the global trade environment. So overall, coming back to it, very, very positive story on India that I think is likely to continue.
Robert, a great conversation. I enjoyed the chat. I hope you did too, and I hope our viewers found it very, very helpful. Just a broad way to think about where economies, in the face of all this news flow, stand at this point in time. Very positive as far as the India story is concerned. Thank you for joining us, and hope to see you again soon, Robert. With that, it's a wrap here on this edition of the Global Reset. Stay tuned, more coming up on the other side of this break.